and welcome to PwC IFRS Talks, your source for all things IFRS, technical accounting matters, business issues, current standard setting, and regulatory updates. I'm your host, Andrea Pride, and with me today I have Gary Berchowitz, who is the CAT team leader in GACS. The topic for today's podcast is Special Purpose Acquisition Companies, or SPACs. And there's been lots in the news at the moment about a bit of a boom in SPACs. We've seen reports that in the last 12 months, the amount of money raised using a SPAC has rose to over 120 billion, according to Bloomberg. And so this has been as much in the first half as of the whole of first half of 2020. But before we get into that, let's go back to the beginning. Gary, welcome. And can you tell us what exactly a SPAC is?
Hi, Andrea. Hi, everyone. Yeah. So as you said, a SPAC is a special purpose acquisition company. So there we go. Enough said.
So that's I'm sure there's more to it than that.
Yeah, no, that's just the name it's been given, and people bandy this word around SPACs. But I mean, what it really is at its core is a type of vehicle through which companies and investors are raising funding and doing a couple of things. And I think the first is it's a way in which a private company can actually become a public company. And the second objective is it's a way in which folks can realize value from becoming public companies and obtaining capitalization funding, so that the private company actually obtains capitalization funding. And what makes SPACs a little bit different from other types of arrangements is you generally get this shell set up, and a bunch of investors then say, cool, we're gonna do an IPO on this shell. And so they will actually initial public offering or capitalize the shell with their own money and external money. And then the SPAC is effectively, in most cases, a shell that has a whack load of cash sitting in it. And then over an agreed period of time, this special purpose acquisition company, or SPAC, will go out and look for a target private company that's looking to go public potentially. And they normally have a set period in which they're going to try to do this. And then they'll either be successful and find a private company that wants to go public, and they'll agree on the terms, and they will merge, and thereafter the SPAC acquires the private company, and then the combined entity is a public company. Or alternatively, they might not find a target, or they might find a target, but the shareholders of the SPAC are not that keen to do the merger because the price isn't right, in which case they will dissolve the SPAC and give everyone their money back. Yeah, and so you
in a way, isn't it? It's a bit like, I've got this check sitting here with an exploding offer date, and if you don't spend it, then it's gone.
Yeah, pretty much. And I think again, you get different versions of this. I think again, it's difficult to say there's one size fits all for SPACs, because in some cases it can be at an individual investor level. You can decide whether or not you want to go ahead with the arrangement or not. So that, as you said, that kind of uncashed check can either be an all or nothing, or there can be lots of little checks that, depending on whether or not the individuals who put the money in are comfortable to go ahead with it, they can say yes or no. And then they might, get their money back, and the SPAC still goes ahead with the remaining money, or they need to obtain additional funding. So as part of the merger, the SPAC gets a second round of funding, or it gets some loan funding. So you get many shapes and forms of this. But as I said, going back to the beginning, I think the important thing is these are vehicles through which people are trying to realize value in IPOing a private company, and in other words, taking it public and also getting capitalization for the private company.
Okay, so why would you use a SPAC rather than, say, just a normal IPO or a reverse merger, or any of the other ways that you can do to raise the money?
Yeah, I mean, that's a great question. I think some of our astute listeners are probably thinking this sounds a lot like a reverse merger or a shell merger that we've seen before. And a lot of the complexities, at least from an accounting perspective and the economics, are similar to that. So if you think about it, we have seen in the past reverse mergers where you take a public company that's a penny stock company, so it really has nothing in it. All it is public. And it is a vehicle through which private companies can effectively list without needing to go through some of the more onerous requirements, filing requirements. They still need to go through filing requirements, but you aren't doing an initial public offering. You're being acquired by a public company. But as we know, in reverse acquisition, when they issue equity, when that public company issues equity to acquire the private company, it ends up issuing so much equity that the shareholders of the private company effectively become the owners of the overall combined entity, and that's why we call it a reverse acquisition. And so if you think about it, a SPAC is in many cases very similar, except it's got obviously a couple of extra rings and bells in there, in that it's got a bucket load of cash sitting in it sometimes, which means that the exchange ratio between the SPAC shareholders and the private company shareholders can get a little bit more substantive than it normally is with a traditional reverse acquisition. So again, it's another way of going public without necessarily needing to do an initial public offering. And it's a way in which, investors who, as you said, there's a lot of money, I think, in the system that has been pent up as a result of folks being a little bit more risk averse during the pandemic, looking to realize some of that value by merging with a private company and realizing that value through the IPO.
Okay, so there's a little bit less in the way, it's a little bit faster, I guess, from what you're saying about not needing as much of the paperwork of an IPO. And you mentioned that there's a lot of money pent up in the system. Is that why they're so popular at the moment, or is there anything else driving this?
Well, yeah, I mean, that's probably worthwhile reading that Bloomberg article you referred to. I mean, this is just conjecture on my part, but I mean, that's what I suspect, is that there's, a lot of pent up capital in the system as folks have been risk averse over the last kind of 12 or 18 months. And I think, again, it is an innovative way of realizing some of that value, because I think the folks who set these SPACs up are then on the lookouts for opportunities to add value both to the folks who invested money into the SPAC, but also providing value to a private company who might want to go public, and their shareholders might want to realize value in the, obviously making their private company public, then they can realize value in their share price because it'll be more liquid. So I think there's something in it for both parties, and as I said, I think it's because folks are on the lookout to realize some value from cash they've potentially been sitting on for a period of time.
Okay, cool. So this is IFRS talks after all. What does the accounting for SPACs look like? What are the issues around accounting for SPACs under IFRS?
Yeah, thanks, Andrea. And obviously these transactions are complicated from a business perspective, and the good news is that creates some interesting complexities from an accounting perspective. And I'd say, having had a look at these, the key question, or probably the most important question that you really need to get right with these SPACs, is identifying who is the acquirer, or which entity is the acquirer. Because if you think about it legally, it may look like the SPAC has acquired the OpCo, because it'll issue shares or potentially pay some cash or a bit of both. And legally, then the OpCo will become a subsidiary, or the private company will become a subsidiary of the public company. But in many cases, when there's equity instruments issued, if you end up with the acquiree, the private company's shareholders, effectively owning a far greater proportion of the shares after the transaction, you may end up actually concluding from an accounting perspective that it was actually the private company that acquired the shell or the SPAC that was sitting on the cash.
Okay, so what would be the implications of that? What would be the implications if, say, the operating company, the subsidiary legally acquires the SPAC?
Yeah, and I mean, I'll try to cover them relatively briefly, because, as I said, there are a couple of questions and they're all really exciting. But I think if we just start with, if you end up saying, look, in some cases, let's say the SPAC does actually acquire the legal entity. Let's assume they don't pay any equity, they just use all the cash that's in there to acquire the legal subsidiary. Then generally, then the SPAC can be the accounting acquirer. They've just paid a lot of cash to acquire it, and your normal IFRS 3 business combination requirements would be applied. I think it gets far more exciting when you conclude actually that it is a reverse acquisition or reverse merger, and it's concluded that it's the OpCo that's effectively acquired the SPAC. Because I think then the first question that we might ask is, well, is this actually a business combination? Because again, folks will recall, in order to have a business combination, as the name suggests, you need to actually acquire a business. And in many cases, the SPAC, as I've described it, is really just sitting on predominantly a bucket load of cash and maybe some other insignificant assets and liabilities. So if you think about it from an accounting perspective, it might not actually meet the definition of a business combination. What's actually happened is the target, the legal subsidiary, or the OpCo, as we're calling it, has just acquired a whole lot of cash. But that wouldn't be accounted for as a business combination, which means you need to think about what other standards might apply. And interestingly enough, in many cases, IFRS 2 actually becomes the applicable guidance, our standard on share-based payments, because what you'll find in a lot of cases is there is some form of premium or cost that the operating company has paid to the SPAC shareholders for the benefits of obtaining a listing.
Right. So I don't suppose that share-based payments is where anyone would have expected these to arrive
No.
for the accounting when they set them up.
It's not the natural place to go to when you have a legal business combination to say actually there's a share-based payment sitting in here. But funnily enough, IFRS 2 is everywhere.
So IFRS 2 isn't at all where I'd have expected us to end up with these. Can you tell us a little bit about what that would look like, what the IFRS 2 charge would be, for example?
Yeah, sure, Andrea. Another great question, because I guess folks would say, what is the share-based payment to the goods or services I'm receiving? And I think that the challenge here is a lot of it comes down to the different values that are exchanged. Because in a lot of SPAC arrangements, there'll be a transfer of equities. So the SPAC shareholder will issue equity to legally acquire the OpCo, and at the same time, the OpCo shareholders will give their own equity to the SPAC, but they in turn will obtain shares in the SPAC. And when you look at the exchanges of those two equities, in many cases, the OpCo effectively appears to be overpaying for what's in the SPAC based on the relative values of the two entities. And IFRS 2, as we know, captures situations where you've issued equity in excess of the fair value of the equity, and we need to look for the unidentified goods and services. And I think in many cases, I think the IFRIC actually looked at this in the past, the economics or the commercial reality is that excess represents the cost of obtaining a listing. And so you need to kind of do the economics, and the calculation of the transfer of the values. But in many cases, you see that there is an implicit excess amount of value provided from the OpCo shareholders, and that excess represents the share-based payments.
Okay, good. And are there any other standards or complexities that people need to be aware about?
Yeah, absolutely. And so I'll just maybe rattle through a couple of them just to get folks ruminating on what might be exciting if you have one of these arrangements. The first is transaction costs. In a lot of cases, these transaction costs can be significant to folks. And there's a question around, well, can I actually take the debit on those costs that are incurred directly to equity, because am I actually issuing new equity? As we know, I-32 says if you've got direct and incremental costs related to the issuance of new equity, those costs can be capitalized or written off directly against equity. And I think, again, one of the challenges around SPACs is what is actually going on. Are you issuing new equity instruments, or are you just doing, these were always your equity instruments, you're just listing them now, in which case they wouldn't be subject to taking any of those transaction costs through equity. I think another question is in a lot of SPAC arrangements, you see contingently issuable shares. So you may see situations where the SPAC might issue incremental shares contingent on certain targets or performance measures. Similarly, the OpCo or private company might have additional issues of shares. And again, determining whether or not IFRS 3, IFRS 2, or potentially even IS32 applies to these contingent share issuers, depends on the substance of the arrangements and the assessments of the accounting acquirer. And lastly, no podcast would be complete without talking about taxes. So obviously, in many cases, there can be tax implications. And again, that's impacted by whether or not you have a business combination or not. As we know, the initial recognition exemption doesn't apply when you have a business combination. But if you don't have a business combination, you might still have to look at whether or not there's a change in the carrying values or the tax basis of the related assets and liabilities. And then the last thing that I did want to mention is just some presentation challenges. So again, I think two of the things to watch out for is how you present your equity, because again, legally, you've got the SPAC being the legal acquirer, but if you end up saying this is effectively a reverse acquisition or reverse merger, you need to bear in mind how you're going to present the equity, because it's effectively the OpCo is the company that we're saying is the accounting acquirer. And another issue then, as we know, anytime you have a reverse merger or reverse acquisition, you need to think about how you might adjust or calculate your EPS. So
right, so lots of standards to think about and lots of places to look in the accounting. Gary, you mentioned earlier, well, you talked a little bit about how a SPAC is different from an IPO or a reverse merger, and clearly they're different, but I'm assuming that there'll still be quite a lot of regulatory interest in these arrangements. Can you tell us about the regulatory requirements?
Yeah, sure. And I think you also actually mentioned earlier, sometimes it might be quicker. I'm not sure, having chatted to a couple of folks on this, I'm actually myself, I'm not actually sure if it is a more efficient or easy way to list. It probably is. But I think the important thing to note here is that there still are and can be a significant and onerous amount of filing requirements with the regulator that you need to comply with. And I'd say, I'd almost say, the accounting is half of the complexities to look at, but just make sure that you don't fall foul of any of the regulatory requirements as well relating to SPACs or reverse mergers.
You mean it's not all about the accounting?
I'd love to say it is, but I don't think in this case it would be fair to do so. No, yeah.
Okay. So, Gary, just to wrap up then, could you give us some last minute words of advice to anyone who has a SPAC coming across their desk? What would you say that you should do other than maybe run for the hills?
Well, I would hopefully not run for the hills, because I guess capital market activity is generally always good for the economy. So I think it's good that we're seeing this activity in action. But I do think from an accounting and a reporting perspective, it kicks up multiple complexities, some of which I think we're still kind of ironing out the details on how they should be accounted for. So I guess my parting advice would be, if you do get one of these, you should definitely consult with some specialists or some folks who have seen a couple of these before.
Okay, great. So thank you for coming on to IFRS Talks and telling us all about the complexities of SPAC accounting, Gary. And thanks to all our listeners. Stay safe until the next time, and happy accounting.
The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.